Smart Money Concepts, or SMC, is one of the most talked about trading frameworks right now, and for good reason. It shifts your entire perspective from lagging indicators and textbook patterns to understanding how institutional money actually flows through the market. But with so much noise around it online, it's hard to know where to start. So in this video, I'm cutting through all of it and giving you a clear, no-fluff breakdown of the core concepts in just 13 minutes. Let's get into it. So first things first, what exactly is SMC? Smart Money Concepts is a trading methodology built around the idea that the financial markets are not random. They are deliberately engineered and controlled by large institutional players. We're talking about banks, hedge funds, central banks, and large financial institutions. These are the entities that move billions of dollars through the market every single day. Now, here's the problem for the average retail trader. These institutions cannot simply click a buy or sell button and fill their entire order in one go. The market doesn't have enough liquidity at any single point to absorb that kind of volume. So what do? They engineer price movement to create the conditions they need to fill their orders. They hunt stop losses, they manipulate price, and they create false moves that trick retail traders into going in the wrong direction. SMC teaches you to read those footprints. Instead of following indicators or basic support and resistance lines, you learn to think like the institutions. You start reading the market through the lens of liquidity, order flow, and market structure. Once you understand what the institutions are doing, you stop being the person getting hunted, and you start positioning alongside the money that actually moves the market. The foundation of SMC is market structure. Before you can do anything else, you need to understand how price moves and what that movement means. Price never moves in a straight line. It moves in waves, creating higher highs and higher lows in an uptrend, and lower lows and lower highs in a downtrend. In SMC, we refer to these key points on the chart as swing highs and swing lows. When you see price consistently making higher highs and higher lows, you are in a bullish market structure. When price is making lower lows and lower highs, you are in a bearish market structure. The critical moment we watch for is what's called a change of character, or CHOCH, and a break of structure, often abbreviated as BOS. A break of structure happens when price continues in the direction of the prevailing trend. It confirms the trend is still intact. A change of character is different. This is when price breaks a significant swing point in the opposite direction of the trend, signaling that the market may be shifting. This is often the earliest signal that smart money is reversing their position. Understanding structure gives you the big picture. It tells you whether you should be looking for buy opportunities or sell opportunities. Never trade against the structure unless you have very strong confirmation. Always let market structure guide your directional bias first. This is one of the most powerful concepts in all of SMC, and it's the one that separates this methodology from everything else out there. Liquidity, in simple terms, refers to where there are a large number of pending orders in the market. Where do most retail traders place their stop losses? Above swing highs and below swing lows. Traders who are in short positions put their stops above recent highs. Traders in long positions put their stops below recent lows. What this means is that above every significant swing high, there is a pool of buy stop orders waiting. Below every significant swing low, there is a pool of sell stop orders waiting. These pools of orders are what institutions are hunting. Smart money needs liquidity to fill their large orders. So they drive price up to grab the stops sitting above swing highs, fill their sell orders at those elevated prices, and then push price back down. They do the opposite on the downside. Drive price down to take out the stops below swing lows, fill their buy orders at those depressed prices, and then push price back up. When you see price spike through an obvious level and then immediately reverse, that's not random. That's an institution collecting liquidity. As an SMC trader, you're watching for these liquidity grabs. You want to see price take out a pool of liquidity and then show you a reversal signal. That reversal is your entry opportunity. Look for equal highs and equal lows on your chart. Retail traders see those as strong support and resistance. Smart money sees those as a target, a pool of liquidity sitting there waiting to be collected. Once you understand liquidity, the next key concept is order blocks. An order block is essentially the last significant candle or series of candles before a major impulsive move. This is where institutions place their orders before driving price aggressively in one direction. Think about it this way. Before an institution can push the market up strongly, they need to build their long position. They do that by accumulating buy orders in a specific price range. That price range is the order block. After price moves away aggressively from that zone, it will often return to that area in the future to collect more orders, or to offer institutions the opportunity to add to their positions. A bullish order block is typically the last bearish candle before a strong bullish impulse. A bearish order block is the last bullish candle before a strong bearish impulse. When price returns to these zones, you have a high probability opportunity to trade in the direction of the original impulse. Not every order block is valid. You want to look for order blocks that are associated with a break of structure or a change of character, because that tells you there was significant institutional activity at that level. You also want to see a clean return to the zone. Price should come back in a smooth, controlled manner, not in another aggressive impulse. When price comes back to an order block, look for confirmation before entering. That confirmation might be a rejection wick, a specific candle pattern, or a lower time frame. Change of character within the zone itself. Fair value gaps, also called FVGs or imbalances, are another critical piece of the SMC puzzle. A fair value gap occurs when price moves so rapidly in one direction that it leaves behind a gap in the chart where no real trading occurred on both sides. Technically, it appears as a three-candle pattern, where the first candle's high and the third candle's low don't overlap, leaving a gap in between. This gap represents an imbalance in the market. Price moved too fast and left behind inefficiency. Markets, by their nature, tend to want to return to areas of inefficiency to balance out. So, when price creates a fair value gap, there's a strong probability that price will return to fill that gap at some point in the future. In SMC trading, fair value gaps are used as entry zones, in a very similar way to order blocks. When price returns to a bullish fair value gap in an uptrend, you look for long positions. When price returns to a bearish fair value gap in a downtrend, you look for short positions. The best trades happen when you have confluence. When a fair value gap overlaps with an order block, you have an extremely strong area of interest. That's where smart money has the highest probability of stepping in. Those combined zones are sometimes called optimal trade entry zones, and they are where you want to be placing your orders. Okay, so now you understand the individual pieces. Let's talk about how you actually put this together into a real trade setup. Here's a simple step-by-step framework. Step 1. Identify the higher time frame trend and structure. Start on the daily or 4-hour chart. Determine whether the market is in a bullish or bearish structure. This gives you your directional bias. You will only be looking for trades in this direction. Step 2. Identify liquidity levels. On your higher time frame, mark the obvious swing highs and swing lows. Mark any equal highs or equal lows. These are your liquidity targets. Know where the smart money will likely be hunting. Step 3. Wait for a liquidity grab. Watch for price to spike into a liquidity pool and then reject. A bullish setup starts with price sweeping below a swing low and then reversing back up. A bearish setup starts with price sweeping above a swing high and then reversing back down. Step 4. Drop to a lower time frame. Once you've seen the liquidity grab on the higher time frame, drop down to a lower time frame, usually the 15-minute or 5-minute chart, and look for confirmation. You want to see a change of character on the lower time frame, confirming that smart money has stepped in. Step 5. Find your point of interest. Look for the nearest order block or fair value gap that forms after the change of character on the lower time frame. This is your entry zone. Step 6. Execute and manage the trade. Enter when price returns to your point of interest. Place your stop loss below the order block for a long trade or above it for a short trade. Set your take profit at the next liquidity pool, the nearest swing high for longs or the nearest swing low for shorts. Aim for at minimum a 2-to-1 risk-to-reward ratio. Many experienced SMC traders target 3-to-1 or higher. Now let's talk about the mistakes that most beginners make when they start learning SMC, because these will save you a lot of time and a lot of money. Mistake number 1. Overcomplicating everything. SMC can seem overwhelming at first. There are a lot of concepts and a lot of terms, but the core idea is simple. Find where the smart money is and trade with them. Don't try to use every concept on every trade. Master one concept at a time. Mistake number 2. Trading without higher time frame confluence. This is huge. If you're looking for a short entry on the 5-minute chart, but the daily chart is screaming bullish, you're fighting an uphill battle. Always align your trades with the higher time frame bias. Mistake number 3. Not waiting for confirmation. A lot of traders see a liquidity grab and immediately jump in before price has confirmed the reversal. Be patient. Wait for that change of character on the lower time frame. Confirmation is everything. Mistake number 4. Ignoring risk management. Even the best setup can fail. No strategy has a 100% win rate. Make sure your position sizing is correct, your stop loss is always placed, and you never risk more than 1 to 2% of your account on a single trade. Smart money concepts is not a magic formula. It requires screen time, practice, and a genuine commitment to understanding how the market works at a deeper level. The traders who succeed with SMC are the ones who put in the work, journal their trades, and continuously refine their understanding. But here's the thing. Once this clicks, you will never look at the market the same way again. You'll stop being confused by sudden reversals or unexpected spikes. You'll start seeing the footprints that institutions leave behind on every single chart, in every single market, every single day. If this video helped you, drop a comment below and let me know which concept was the most eye-opening for you. Hit the like button if you want to see more SMC content, and subscribe because we break down these concepts in detail every single week. Links to more in-depth videos on each of these topics are in the description below. Trade smart, manage your risk, and I'll see you in the next one.